My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is Anna Coulling, who a lot of people that I follow track as well. Looked a little bit into her background and really thought this would be a worthwhile conversation. Anna, for those who are not familiar with you, introduce yourself. Who are you? What's your background? How'd you get interested, involved in markets? And how in the world do you find time to write so many books?
Well, the book writing has actually stopped now. My really, this whole market thing is something that my husband and I got into. Oh goodness, maybe 25 years ago. I'm here in the UK. At the time, we lived very close to the city of London. We were involved with a lot of financial banks and brokers and institutions, not on the trading side, I hasten to add. It was another business that we had, but we used to spend an awful lot of our time crawling around trading rooms, working, as I said, with these financial institutions. But we really didn't understand what was going on. We came across an article in the Times. It was an event that was going to be put on actually on the Thames on a boat called the President, a very famous boat. It was an icebreaker, I think, from the turn of the 20th century. And it was really saying, do you want to know about trading? Do you want to sort of get involved with the financial markets, et cetera, et cetera? And because it was the Times and it carried, it was a very respected newspaper, my husband and I said, well, why don't we go along? We're in the city. Let's go and find out a little bit more about it. And you have to remember, back in the day, there was no internet. Access to the markets from the retail side was, I think, it was practically non-existent. So, maybe in the States, things were sort of opening up. And we went along, my husband went along, and we went to a presentation. And in this presentation, it was really interesting. There was stuff there. We had no idea what was going on in these buildings that we used to spend our working lives in. But the one thing I have to say from that experience was that we were introduced to the principles and concepts of using price action and volume as the basis of your technical analysis. So despite the money we spent, the journey that it took us on, my husband and I, we have never regretted that first step. So from there, no, we didn't quit our jobs. It was something we were going to do, incorporated into what we were doing at the time. We had a home office set up. We had terminals. The data feed came in via a satellite, which was stuck to the side of the house. We were lucky, if it was a sunny day, if it was a cloudy day, there was an interruption in the data feed. And for our, God help us, our first trades were in the FTSE futures, which, you would think, why would you start with FTSE futures at something like 10 British pounds a point, which is about $12 a point? Well, as I say, we're talking nearly 25 years ago here. Completely the wrong thing to do. Placing trades was, we had a special phone. It was a bright red phone. It looked like the phone that the president of the United States has on his desk, is waiting for that dreaded call that there's been a nuclear strike, or he's going to sanction a nuclear strike. We had to phone up. We were taught a specific script, how to speak to our broker, and in the background we could hear the order going into the obviously into the pit, into the Liffey pit, which was still functioning at that time. So that's how we started. From there, we then went off into all sorts of different directions. We actually got into stocks, and the last market we got into was the forex market, always using the same approach, the same base methodology, which was looking at this very special relationship that exists between the price action and the volume. And also at the time, which I think was really quite revolutionary, we used candlesticks. We were introduced to the concept of candlesticks. Everyone takes candlesticks for granted these days, but you have to remember, at the time, they were sort of fairly novel. The Japanese traders have been using them for many years. The Japanese banks of course, were using them. but everyone was pretty much using bars. But as I said, we were just very, very lucky that it all came together at the right time for us. Now, the books didn't really come along for a little while after that, because although we had this base methodology, it was, we were just taught, as I said, the very, very basics. And it was only through spending hundreds of hours looking at charts, looking at different markets, that we said, look, there's got to be more to this than just the price action and volume. Of course, we had indicators. I think we used moving averages. You go through the whole gamut of indicators that are available on your platform, but we kind of had a kind of an aha moment when, just studying the charts, we said, it is price action and volume. Of course, that is the basics, but it's also chart patterns. It's also individual candles, the power of individual candles, but it's also support and resistance. It's also time, and time, not only the chart that you're trading, but also looking at multiple timeframes. Multiple timeframes are just so important, together with, as I said, the support and resistance levels that are very important on the slower time frame charts, will come into play if you are on a faster time frame. You could be on a faster time frame, you could be taking a trade, and suddenly your trade just stops, and you think, well, what the heck's going on? But you can look at a slower time frame. You can, if you're on the 5-minute chart, you can look at the hourly chart, and you say, that's why it's come to a pause point, because on the hourly chart, it's a key area. There's been a reversal there. You're moving into a congestion phase. So, as I said, from that's really when the book, the basis of the book started to come together. In the meantime, we also did go back to sort of studying the concepts of Richard Wyckoff. The complete guide to volume price analysis pays homage to Richard Wyckoff. Is based on his three basic laws, and it kind of all went on from there. And we did that. That was a sort of general book. It can be applied to all markets. And when we got into the Forex market, I wanted to do one specifically for Forex. There's also a book out there that's called The 3D Approach to Forex Trading, because we all start with charts, but we all soon pretty much realize that the drivers for whatever we're trading, and certainly in the Forex market, you begin to realize you've got to have an appreciation of what is going on the fundamental level, on the releases that are going. Of course, you've got the central banks now, and God help us, you've got the central banks, having a major, major impact across all markets. And from there, it was looking at, well, do we also have to look at what I call cross-related markets, cross-market analysis? And it applies to whether you're, as I said, you are a trader and you're on the faster charts, or whether you're an investor. And of course, for a stock investor, you then also have to bring in the metrics for the stock that you have under consideration. But the technical picture is, as I said, it's very much rooted in the concepts that I've put together, that I've called volume price analysis. And really, that's where we are now. I think the last book we did was a book of examples, because the concepts are all well and good, but it's actually nice to see them in charts. And if when people ask me, what is the advantage? What does VPA give me as an advantage? Well, there are a number. What it tells you is, it reveals the truth behind the price action. Is the price action you're seeing on that chart genuine or not? Is it a trap move? The relationship between the spread of the candle, the wicks, and the volume underneath it tell you so much of what is not only is going on, but what is likely to come next. And I do accept price action traders. If you're just a price action trader, volume is something that not really part of your thing, part of your strategy. Fine, and if it serves you well, then fine. But do consider volume, because it just gives you, as I said, it's really the only metric we have to tell us whether the move that we are seeing, as I said, is genuine or not. And I think also what it does, certainly speaking from the many traders who use the methodology, is it takes away some of the emotion, some of the fear that is always part of trading. We have to manage that fear, the fear of a loss. I'm in this trade. Is it going to go higher? Should I take my profit now? What's going on with the volume there? It just takes away the edge off that, if you like.
And I want to expand on that, because I think there's a lot there to unpack,
Sure.
to relate in terms of that. And by the way, for those that are in the audience, I'm amazed actually by a lot of what Anna's done. If you look at the reviews on Amazon, as somebody who has republished my own father's book, I can tell you it's not easy to get people to read your book, let alone review it. I mean, she's got several books on Amazon, very well reviewed, with a large number of reviews. But I want to relate three things that you said during that initial intro. So one is,
Sure.
the inner workings. Right, so we can get into sort of maybe how the inner workings of the market has obviously changed, right, from decades ago to where we are now. But I want to relate the inner workings question in terms of time frame and volume. So I'm going to make the argument that we're in an environment where there's more noise than ever before, because the inner workings of the market have changed so much, and because there's a lot of ways of getting access to a particular stock without necessarily trading the stock itself, for example, right? Or even when it comes to Forex, I'd argue. How have things changed over the last several decades in terms of thinking about price, volume, and the issue of whether it's noisier today, depending on time frame?
I think it's noisier. Part of the reason is because of the participation level. That's one of the things that you have to remember. When we were around, the retail cohort was practically non-existent. I mean, I don't know what it is, but the figures are really quite extraordinary. So yes, you are getting more noise. I still think that the volume, and with stocks in particular, where you have the absolute volume, so by the end of the session the number of shares that stocks that have been trading. But there is also now the sort of more statistical approach to it, which is looking at the relative volume. To me, that's looking at what I call benchmarking. When you've looked at so many number of charts that I have, and my husband David has, you do get a feel in a stock whether the volume that you're seeing coming in is what it should be for that particular stock. And the tools we have available now, in terms of filters, as I said, measurement of what I call, so sort of the relative volume in stock. If you know how to use them and how to interpret them, and you then apply them to the chart, I think that's what gives you the extra clues, if you like. But of course, it's different for a trader and an investor. So, if you're looking for a stock to trade, not only do you want a stock that has got more liquidity, because otherwise it's not going to do very much, but you would also want to look for a stock with a relatively strong relative volume, because something is going to happen. You're not going to be in there very long. As an investor, looking at unusual volume and even relative volume, particularly if the chart is in some kind of consolidation and you suddenly see a volume spike and you say, that's interesting. Maybe it's one that I should put on my watch list. But then, you also look at that within the context of, well, for a stock? Is it coming up to an earnings? Is there an event that is going to influence that stock? Is there an what's the story behind the stock? And also, as I said, the cross market analysis. What is happening what is the sentiment in the market? What are other markets telling you? Is the stock in a sector that is, from a cyclical perspective, is probably going to go down? I'm not going to go through the whole related market theory, the cross market analysis thing, intermarket analysis. I mean, John Murphy's got a book. Is it your father? You said your father's book
Yeah,
as
that's
well.
been my primary, right? And that's my
That's
primary was in
right. That's right. So if you like, you can sometimes pick the volume out ahead of what may be coming down the line, and but it's still noisy. To answer your question, I think that noise is simply the number of the sheer number of retail traders, and they are having an effect, certainly in the stock market and even in the forex market now. They may not necessarily
although
be
that's
on
it.
the right side.
Right. Although that's interesting though, because I think that so I'm with you on that point that the volume. Some would argue, and I myself personally tend to lean on this, but I don't have any real proof around it. That volume is not as important as it used to be because there's so much more participation. To your point, zero commissions, retail, so it creates more noise to really even determine if the volume is meaningful of anything. But presumably the retail participation in stocks is going to be different than retail participation in forex, because forex typically is not as volatile, doesn't kind of attract the fast money type of quick get rich quick type of traders. So is there anything to the idea that volume is more of a tell in certain asset classes over others, in particular those that don't have as much retail relative participation?
I wouldn't say. I would say not. I mean, the I mean, I look at the only market I don't really look very closely at is the bond. I'll rephrase that. I look at the bond market. I don't study the bond market charts from a VPA perspective particularly, but I certainly look at what the bond market is doing generally in terms of yield and etc. The bond market. We've got an upcoming stock trading and investing course, and the bond market is a huge part of that. If you don't understand the bond market, you are really going to run into trouble. If you're either a long-term investor or even a trader. I would say not. And may I just give you an example of that? I've been doing some analysis, certainly since the beginning of the year, on where the retail, where there has been strong retail flows, and I've been looking into the some tech stocks, in particular Nvidia. I've been looking at Meta, and I was looking at AMD, and simply by looking at the charts. After the holiday period, you could actually see, yes, there's been a big, retail participation, but looking at the chart pattern and the volume beneath it, it's really strong volume. And then the Nvidia has now exploded higher, but the groundwork for the move higher in Nvidia came at the beginning of the year, if not back in certainly for Meta back in October. So by looking at volume and looking at stocks maybe that aren't sort of headline news, as it were, you can pick these potential turning points. The media obviously jump on the latest thing. They have it's a 24/7 cycle. You've got to produce something, you've got to write something, but often the opportunities are there. And the thing is, with using volume, was the concept, as I said, of VPA, is these signals, these patterns repeat. If you spend long enough looking at the charts, looking at even the monthly chart, and you see a long period of the consolidation coming. You can see the volume. The price isn't going down. It's almost as if the stock is resting, as it were. It's waiting for a catalyst. But that's when the accumulation happens, and boy, then it explodes, hits the front page of the media. Everybody jumps in, and what happens? oh dear, there's a massive pullback. And if I can say also on pullbacks generally, VPA is not just for the reversals, for looking for the accumulation. It's when you're in a trade, especially on the shorter time frames, it's absolutely brilliant when something pulls back against you and you look at the candle combination with the volume bars in real time, and you say, haha, yeah, that's just a pullback. There's no volume to support it. You need volume on the way up, but you also need volume on the way down. So that's what I would say.
So I think actually this is a good transition just to a little bit of talk around the current market environment, especially around maybe how volume price analysis might tell you something about the banks, in particular with European banks. I'm curious how, first of all, how closely have you been tracking what's been going on the last several weeks in terms of the financial sector? I mean, now it looks like it's metastasizing to something larger when it comes to Europe. Any interesting observations with your way of looking at markets, looking at volume that you think are worth noting now?
Um, yeah, I've been paying very close attention to what is happening, the financials and the banks. I find it's really whether how much contagion, if any, we're going to get from what has happened in the US, out to Europe, so far in London. When central bankers sort of say to you, everything's fine, you kind of, you have to take a step back and think, yeah, right, okay, we've got to keep going, because God help us if there is financial Armageddon. No one's going to come out very well. We're all going to suffer. What I've been doing is just to sort of keeping an eye on things more closely. Is not necessarily through the individual bank stocks, but looking at the ETFs, at the sectors, and seeing what's happening there. Is there massive outflows going in? Is there buying going in? I don't think we're at the what I have found, and this is when VPA also can come into play, is just, again, best way I can describe it is to give you an example. This market generally hasn't wanted to fall. I mean, the bears have been calling, this is a big bear market. It's all going to go down. That's it. There's going to be a massive crash. That may happen, but if you actually look at the volume that has been going in, I mean, I was looking at the YM, and you look at the candles, there's been buying going in. There's been buying going into tech. So
I'm
this
curious.
contradiction.
Yeah, no, and hold on, and so not to interrupt, but I think this is important for the audience because, there is this constant bid that's still happening, but it's worth noting, to your point about tech, that constant bid is primarily around large caps, right? I mean,
It
because you have
is.
these kind of automatic flows into passive, market cap weighted type of indices.
Yes, but it's almost as if that what I found fascinating is that people would rather park their money with Apple and Microsoft and in gold than they've almost become quasi safe havens. And if you think about it, I was looking at the debt ratio for Apple. I think it was yesterday, and the sheer amount of money that they have. I mean, let's hope they have it insured somewhere. It's not going to go up in a puff of smoke. And people are saying, hey, I think I can trust Apple more than I can trust my regional bank. I was looking at the ETF for regional bank. I was looking at the KRE, I think, and it was just pulling together what's out there in terms of other market assets and forming a picture which will then kind of support what you see on the chart as well. And with VPA, sometimes it is a bit of a contrarian indicator with the volume, because, and I can only draw your attention back to that iconic S&P down at 666 back in 2009, I think it was. Well, if you look at that and you look at the candle and the volume under that 666, you looked at it and you think, yeah, that was a huge, that was a, a big hammer candle, because within the, the candle lexicon, there are very strong candles, of which the hammer is a classic, and the shooting star is, but it has to have, the requisite amount of volume. It's also anomalous, because you would expect the price to carry on lower, but it doesn't. It does the exact opposite. So, as I said, it's at the moment. Are we down? How bad is this going to go? Look at gold. I can't even say look at the US, the dollar, because the other thing with cross-market assets, cross-market analysis is with correlations, is they do break down. They what might work this month may not work. It's nothing is set in stone in what we do, as you know, Michael. It's hugely uncertain, and the as I said, we try and find some certainty, or as much as possible. And what I can say is, from my experience and looking at my charts and what I write about and what we trade, is by looking at the price action and putting it together with the volume, I have found that at least it gives me, takes the worst of the uncertainty away, as it were, and looking at the across markets as well. That's all I can suggest and recommend. But it's not for everybody. It's not for everybody. And I've never. I've never tried to push it. People have said, "Oh, it's rubbish. You don't know." As particularly in forex, where you're talking about tick volume, which has about an 90%, success. So you're not dealing with actual volume, because it's an over the counter market. But as I said, but what I find interesting now is the certainly from some of the YouTube videos that I come across, the number of people who now are incorporating volume into as part of their analysis. Whereas probably 25, when I first did this and even wrote the book, they said, you don't know what you're talking about. This is rubbish. This it's. I said, fine. Well, that's your opinion. What makes you happy? That's fine. So it's me.
So, and by the way, it is it's a good transition to the forex side. It's interesting, referencing gold. As I put out that tweet, kind of little ominous, saying gold is sending a warning. So from my perspective, when I look at markets, I think of things in terms of low volatility, which is risk on environments, and then risk off, which is high volatility, right? Environments. And if you have that mindset, then you frame things in terms of what benefits from low volatility, what benefits from high volatility. Historically,
Sure.
you have kind of four areas, right, that benefit from high volatility. Treasuries tend to be the best performing in high volatility periods for stocks. Wasn't the case last year. Maybe starting to come back. Flight to safety. 2 is gold, 3 is the dollar, and 4 is the utility sector on a relative basis, right? Sure. It's like these are the areas that, if you're really going to play defense, those are the only real ways to do it, as opposed to doing a directional bet by shorting. Now, on the gold point, I'm curious to hear more of your thoughts on that. Personally, I think gold is moving because it's siphoning away some of the risk-off money that went into the dollar last year, which was the clear winner of those 4 high vol risk off type of trades, right? The dollar was clear. It's like I keep joking. If I were to say to anybody at the start of 2022 that the dollar would have been the best inflation hedge, right? I would have been laughed out of the room, but that's factually what happened, right? So when you look at gold and you think about volume and price analysis in gold, you've had pretty much a decade of nothingness. Do you think we're on the verge of some kind of a real
of another bull market? I mean, in fact, I looked at the gold chart the other day. Actually, yesterday, I think I actually wrote about. Just put up something on one of my Facebook pages. Let's have a look here. GC. I looked at the gold futures. The most interesting chart, and this is what I say about using the slower time frames to give you you kind of have to zoom out a little bit sometimes. And what's really interesting with gold, obviously, if you look at the monthly chart, is you have potentially a triple top. You're moving into an area where it has actually come off. You've got the reversal back in August 2020, where you had a high of, let's have a look, I've got it here. You've got the high there, you've got a massive big doji candle with a ton of volume underneath it. That was preceded by a big up candle on the monthly chart, a very widespread up candle. It was also what we designate as part of our indicators, the volatility candle, because the price range of the candle was outside of its average true range. We've just got this little indicator, and it fires off these little arrows at the top and bottom of the candle. Big widespread candle, fired off the indicator, but the volume underneath it was, yeah, I mean, okay, it was July, because there's another aspect of volume, and that is it has to be relative to the instrument in question. As I said, for stocks, that's fairly easy to track these days. Is 2 million of stock being traded on the day on Apple? Is that good, bad, or indifferent? Well, clearly on Apple, it's ridiculous. Apple would never trade just 2 million. But if you're talking about a tiny little penny stock, 2 million is a significant number. So you've got to look at it from the relative perspective. You've also got context in the sense that, well, this is July, and you think, well, July, what are markets like in July? What are they like around holidays? You've it's not just, oh, this is a big candle, this is big volume. Yeah, that's, it's a little bit more nuanced than that. But what was interesting was the range of that candle compared to candles, not even similar candles. This was twice the height of a candle back in August 1919 that had a third more volume. And you think, hold on, you've had this massive up candle, but the volume doesn't sort of reflect, if you like, the price range. Then it was followed by a huge doji candle with reasonable volume as well, and the price actually came off on there. Then you had a classic back in March 2022, much more typical. You had a more like a shooting star candle. It had got to a high of 2078, fell back. Okay, the volume was, it was I would say in proportion. Yeah, something, there was definitely weakness. Wicks to candles tell you so much about the price action. A wick to the top of the candle, that is signaling some kind of weakness. A wick to the bottom of the candle means price support. People have been buying. And from then, back in March 2022, you got down to a low in October of 1640. And it was around the 1640 area where we have now the current rally. But you're really going into, as I said, you're going back into this area. It has to break above. If it does, much of it will depend on what happens in the next few weeks, in the next few months. Then that will provide, as I said, going back to support and resistance, you have a fantastic, strong platform, and maybe you're away to the races. But we will have to see. This month's volume so far has been great, but it's gone straight into this resistance level, as I said, created by this zone, if you like, created by these two failures at this level. So we use the technical analysis, what is happening on the on the fundamental side, what is happening the geopolitical side. I know I've read central banks have been stocking up on gold. I mean, it's a finite resource. So who knows? It's just at a very, I think, at a very, very interesting, but also very, very crucial phase. And that actually comes. Then we have, well, okay, I've missed this move. I didn't get in when it was down at, in the 1600s. It hit a nice support level down there. That was a potential buy. I've now missed this rally. What do I do? If you're going to wait until it breaks through, then, do you like breakout trading? Are you more, with breakout trading, you get a lot of fake outs. The only thing I would say is, look at the volume. If the volume is there to support it, then go for it. Or are you
and
more
where's
a
that
reversal trader?
and for gold, when you talk about volume, Yeah, it's unlike a stock in a sense, right? That, there's going to be multiple places where the volume is coming from. So when you're looking at volume for certain commodities like gold, what's the
Sure.
source? Are you looking at purely futures? You're looking at ETF flows?
I'm looking at no. I'm here. I've got the futures. I've actually got the futures up here. I just look, and I haven't got the open interest at the moment. And if you do want to use the COP data at all, what sometimes happens is where you get those extremes of buyers and sellers in any instrument. Actually, sometimes that can also be a signal that there's a reversal about to take place. As you know, when everyone is facing one side of the market, something's going to give. Something is going to sort of, it's like an elastic band. You can only stretch it so far, and then it'll come it'll come back to the mean, as it were. But gold is a really, really interesting one, and as I said, it's all I can say is if you understand if what VPA also does is, and certainly Wyckoff's three laws is, it gives you an understanding of what I call the structure of the chart. There is a price cycle. The price cycle is self-similar in all the time frames. So it goes from you have a consolidation, you have a trend, you have an accumulation, you have a distribution. It moves through these cycles. Now, they're not in sync in all time frames, obviously, and depending on your time horizon in terms of trading or investing, you will then select the time frames that will suit you. Now, I'm saying to you, look at the monthly chart, and you say, well, why should I look at the monthly chart? I'm only going to, I'm going to be on the 1 minute, 5 minute, and 3 minute chart. Well, the reason I would say look at the monthly chart is because it is at in a particular phase of price action, because you have these two important zones. You are potentially at a triple top. They may come into play even on the faster time frames. That's why I think multiple time frames are so important if you are a trader. And also, by looking at two time frames, you may decide that you are going to go counter what you see on the slower time frame, because you think there is an opportunity to trade that pullback, to trade that correction. You're going to take on more risk. I know you write about and you talk about risk. And at the end of the day, what we try and do is we're trying to reduce the risk as much as possible. I think using VPA and price action and volume helps you to quantify, not I don't want to use quantify that risk so much, but it gives you a perspective on risk that maybe you hadn't appreciated before. Whether you wish to take on more risk for the sake of a few points because you're a scalper, that's fine. But having these levels or being aware of what is going on the slower time frame will also tell you whether the extent of that risk. You say, do you know what, I'm really pushing it here, but do you know what, I've got a bit of headroom because I'm really not going to run into trouble until I reach this particular level, because it's an important level on a slower time frame. That's and I think and what the volume will do, it will help you either not only get in, but more importantly, it helps you to stay in. So that's my answer to that.
Just for the remaining 10, 15 minutes or so, since I have another space right after this, everybody, please make sure you follow Anna Coulling here on Twitter. Check out her various books on Amazon. As you can tell, very knowledgeable, passionate, and very prolific. So I always encourage support for those that are in the arena, constantly putting content out there, and also dealing with the beast that is Mr. or Mrs. Market, I think is the way to frame it, which includes all asset classes, by the way. Okay, this is going to sound like a silly question, but I am curious to hear your thoughts on this, since your focus is on the volume side so much. Does that mean that you're not necessarily considering the housing market or the property market, right? Because you can't really obviously see volume in the same way, but housing, certainly in the States, is a big driver of credit creation and contraction.
Yes.
So How do you factor into that part of the marketplace?
I think well, first of all, I think the market, the property market, is very, very cyclical. So, and that cycle to a greater or lesser extent is to do with interest rates and the availability of money, and which is why, as I said, although I don't look at the treasury chart, the bond charts in terms of am I doing volume price analysis on them? I use them as to tell me what is happening in the wider economy. If sorry, I've got distracted there for a second. With the property market, yes. However, having said that, there is no reason why the ETF market, for commercial real estate, I think I read, is that the first sort of shoe to drop, as it were, because if it's going to be more expensive to fund debt, everything is about the cost of money and the cost of debt. And what is happening at the moment is what the market is. What's clearly been revealed is the Fed's the terminal rate of 5% was just a step too far, for things to continue as they are. Whether the Fed will change, we'll have to wait and see. But certainly, the property market cycle will be part of the economic cycle, and it will also have the cycle to do with the interest rate cycles. Are we going to go in for higher interest rates? Maybe I feel that there is going to be some kind of pause because of, they've looked over the horizon and they don't really like what they see. But like all things in life, it'll be kicked down the road, and possibly we can get away with it for now, but maybe 2020, get through 2020, 24, 25, 26. Maybe that's when we will get the sort of ultimate low, and then things will start going up again. It's partly to do, as I said, with cycles. I have been looking at cycles theory a little bit, and it's really very, very interesting. I'm not an expert on it. I've just been casting my eye on it, and also looking at the people out there who use cycles theory and actually putting VPA on top. And I'm thinking, that's when they called the bottom of that. What was the candles doing? What was the volume doing? And there is a certain amount of synergy there. So yeah, don't ever rule anything out. And my final point about VPA is what I found is I'm often asked about what about level 2 data? Looking at the ladder, looking at what is happening there, and I don't use that. We don't have it in my husband and I in our trading. But what I have found is VPA can actually work very well if you like to use level 2 data, and that's something that we're exploring for the future.
I am curious, to the extent you're comfortable, do you and your husband trade differently? I mean, it sounds like you have the same sort of mindset around markets, but does that mean you're countering each other's trades at times?
We trade different things. Yes, we do. Oh no, it would be ludicrous. We are very different traders. David's trading persona very much reflects his. He was a great sportsman. He used to play an English game called cricket. I suppose he'd be a fantastic baseball player had we done that. His view was you are out to attack. That's it. He very much attacks his charts. He's absolutely brilliant at VPA. I'm much more. I tend to be on the slower time frames. He likes the very fast one. He's on the seconds charts as well. It's the way his brain works. But we stay different markets. He is much more into. He's very heavily traded the dollar, much more forex than I am. I tend to be more on the indices, and we have stocks as well. But our stocks tend to be for investment purposes. We don't trade stocks very much at the moment. No.
From a volume perspective, are there? I don't know if you've done any of this kind of research, but is there anything that would suggest that volume is less noisy in certain sectors or industries over others, right? So, and where I'm going with that is presumably, maybe I'm wrong, but at least from my own studies, I think that makes sense. When you see a lot of volume going into defensive sectors, for example, the stock market, in a big up day, that tends to be, from my perspective, a bit of a warning sign. Is there anything is there anything validity to that idea?
You're right. You're absolutely right. The other thing I would say also is the speed at which flows can go across assets is something that was certainly, I don't remember it being the same sort of back in the day. I mean, you can shift, and that in a way, because of this very, very fast flow, must cause a degree of, I wouldn't say instability, but more, as you said, more noise. So at the very slightest hint that its sentiment is changing, you see the flows going immediately into, as you say, defensive, gold, the US dollar, depending on the severity, if you like, of maybe the geopolitical event, or how much sentiment has deteriorated. I think then, in terms of sectors, I think what you have to look at is, and this is something that's cropped up from our own research and experience, looking at this stock trading and investing. First of all, with sectors, I'm not going to go. It's generally speaking, you have to know what is making up that sector and which stocks are making up that sector. Is it taking, are there two stocks which are, to have a big percentage of that sector? And just to give you another example, I read on a tweet that we're back to the 70s, where in the S&P, I think it's the S&P, Apple and Microsoft now have almost 13% of the index. So there's this whole argument about whether the very construction of indices and sectors are not also distorting what is happening in the market. So if you are looking at individual defensive stocks, fine. I think you have to get a really good handle on what is average for that stock. And we are fortunate in that there are so many good screeners out there. Getting back to what I said before, if you take a stock like Apple, and in the pre-market, for example, it's already done, let's sake of argument, 50 million. It's already traded 50 million in the pre-market. Well, 50 million for Apple, if that is what it does on average on a day, is that stock going to move the rest of the day? Maybe not. If it does 2 million in the pre-market, but it has an average of 50. So going back to looking at individual stocks, as you say, for defensive, look at the ETFs, but then there's a corollary to that, and that is make sure that you know what the percentage, what are the weightings of the different stocks in the sector, because then you can say, well, actually, in this defensive ETF, which is attracting all these flows, 3 stocks make up the bulk of that ETF. Well, maybe I should just look at those 3 ETFs. It's how you draw up your let's call it a dashboard. What do you look at on a daily basis for what you trade or what you invest in? What are those cross markets? What are those, what cross market analysis do I need to do? What do I need to keep my eye on? And then it will give me this, this global picture about sentiment.
I think that's a good place to wrap this Twitter space up, since I have another one in 10 minutes. Everybody, again, please make sure you follow Anna Coulling. Check out her various books on Amazon.
Thank you.
Real pleasure speaking with you, Anna. I'm impressed with everything that you've done. Obviously, very knowledgeable. Everybody, please show support and keep attending these spaces. It's going to be a long, long day for me. Thank you, Anna. Do appreciate it.
Thank you, Michael. Thank you so much, and I do admire your stamina. Have a lovely day, and I have to say to everyone, please, your stuff is amazing. I've looked at fantastic, and the great thing about this business is we can all learn from each other. I don't have the solution to everything, you don't, And I'm always fascinated. And anybody who's listening and who uses VPA, please just drop me a line. Let me know how you have found it, what you're doing with it, because the beauty about it is you make it your own. We haven't even talked about the options market as well, but maybe we'll keep that for another day.
To be continued. Thank you, everybody. Thank you, Anna.
Take care, Michael. Have a lovely day. Bye.